Usually when you think about a grocery store, the mental image is pretty universal. I mean, it's that low hum of the fluorescent lights and
the squeaky shopping cart wheels. Always one bad wheel.
Exactly. Yeah, the one wheel that pulls you into the cereal aisle. And you have that endless row of brightly colored boxes and the undeniable urge to grab a candy bar at the checkout.
Right. It feels like the most traditional, physical, just old school business in the world.
It really does. And the fundamental business model hasn't really changed in, a century? You buy a tomato for 50 cents, you sell it for $1, and you just pray it doesn't rot in the back room before someone puts it in their cart.
It is the original low margin grind. I mean, you're literally fighting for pennies on every single transaction.
Which is why, because it's such a familiar everyday experience, it's so easy to assume the business behind it is just as straightforward. But looking at the notes you brought in today for this deep dive, I'm realizing that assumption is completely wrong.
Oh, completely. The mechanics happening beneath the surface right now are light years away from just stacking apples on a shelf.
Right, because the company selling you that tomato today is actually behaving less like a traditional supermarket and way more like a high-margin digital advertising platform wrapped inside this hyper-local tech logistics network.
Which completely shatters the illusion of the humble grocery store. And more importantly, it changes exactly how we should be looking at the underlying value of these massive retail operations.
So, welcome to the special Talk Tickers edition of our deep dive. Today, we have a very specific mission. We are taking the Q1 earnings call transcript for the Kroger company ticker symbol KR, and we are putting it under the microscope.
Yes, we are going to extract the absolute most critical data points, strip away all that polished Wall Street corporate fluff, and translate the heavy financial jargon into plain English.
And ultimately give you, the retail investor listening right now, an actionable, highly opinionated verdict on this stock.
Because this matters whether you're currently holding Kroger shares in your portfolio, or maybe looking to buy the dip, or honestly, even if you just track the retail sector to get a real-time pulse on the health of the everyday American consumer.
Yeah, the modern grocery store is the ultimate economic bellwether.
It really is. So we are going to give you the key takeaways you actually need to understand what's happening to household budgets right now.
Okay, so we've got new leadership commentary guiding this quarter. Greg Foran is in as CEO, and David Kennerly is the new CFO.
Right.
And they're giving us their unvarnished assessment after their first 100 days of just digging into the guts of the business. And I want to jump straight into the headline numbers here.
Let's do it.
Because on the surface, the revenue and the profit are telling two completely different stories. It almost looks contradictory.
It absolutely does require some interpretation. So let's lay out the hard data they reported for the first quarter.
Oh, okay.
Kroger posted an adjusted earnings per share, or EPS, of $1.58.
Which is strong, right?
Very strong. That is a solid 6% growth year over year. They also hit an adjusted FIFO operating profit of $1.5 billion.
Okay, wait, let's pause right there and decode that for the listener. Because adjusted FIFO operating profit is exactly the kind of Wall Street jargon that makes people's eyes just glaze over.
Fair enough. Let's break it down.
Operating profit is straightforward. I mean, it's the money you make from your actual core business operations before you pay the tax man or deal with debt interest, right?
Mm-hmm.
But FIFO stands for first in, first out. And in the grocery business, how you account for your inventory is a massive deal, especially with inflation.
It is the defining metric for a business that sells perishable goods. First in, first out. Simply means that when Kroger calculates their profit, they assume the first items they put on the shelf are the first ones that get sold.
Which makes perfect sense logically. You put the older milk at the front so it sells before the expiration date.
Right. Physically, that's exactly what happens. But financially, it matters immensely during periods of inflation.
How so?
Well, if wholesale prices are rising, the older inventory, the first in, was bought at a cheaper price than the new stuff arriving on the trucks today.
Oh, I see.
So by using FIFO accounting, Kroger is matching its current sales revenue against the older, cheaper cost of goods.
So it filters out the noise?
Exactly. It gives us a much clearer, less distorted picture of their actual operational efficiency during a volatile pricing environment compared to other accounting methods. Hitting $1.5 billion on that metric is a massive flex.
Which sounds great. $1.5 billion in operating profit, earnings per share growing by a very healthy 6%. But here is where I have to throw a flag on the play.
Uh-oh.
Because looking at the top line, the actual sales revenue, it barely moved. They reported that identical sales, which excludes the highly volatile fuel business and just looks at the core grocery aisles, grew by a mere 1%.
A tiny, tiny margin of growth.
Right. So if sales are practically flat, barely limping along at 1% growth, how on earth did the bottom line earnings jump by 6%?
It's a great question.
I look at that disparity, and my immediate skeptical reaction is that they are masking weak consumer demand with some fancy financial engineering in the back office. You can't squeeze 6% profit out of a 1% sales increase without some serious maneuvering.
It's a completely fair skepticism, and honestly, it's exactly what the institutional analysts on the earnings call were zeroing in on.
So what's the trick?
Well, to understand how you manufacture a 6% bottom line growth from an anemic 1% top line growth, you have to look at two massive underlying stories that dictate the grocery business.
Okay, what's the first one?
The first is an incredibly specific agricultural quirk, and the second is a masterclass in aggressive operational efficiency. Let's tackle the quirk first because it's just fascinating. It's all about eggs.
Wait, eggs? You're telling me that analyzing a multi-billion-dollar corporate revenue strategy hinges on a carton of eggs?
It actually does this quarter. Yeah. The CFO explicitly pointed out that deflation in the egg category was a massive disproportionate headwind to their identical sales numbers.
Really? Just eggs?
Just the drop in the price of eggs alone represented a full 64 basis points of downward pressure on total sales.
Okay, let's break down basis points for anyone new to earnings calls. A basis point is just 1/100th of a percentage point.
Right.
Wall Street uses them because saying 0.64% gets confusing when you're talking about growth rates. So 64 basis points is be your 0.64%.
Exactly.
If Kroger reported 1% sales growth, you're saying that if the price of eggs had just stayed flat, their overall sales growth would have been substantially higher, closer to 1.64%.
Yes. And this illustrates a fundamental paradox in grocery retail. Over the last year, we saw massive spikes in egg prices due to the avian flu outbreaks decimating flocks.
Oh, right. Eggs were like $7 a carton there for a minute.
Exactly. Now the supply has recovered and wholesale egg prices have plummeted. When food inflation cools down, or in this case actively deflates, Kroger brings in less total revenue at the cash register for selling the exact same physical volume of food.
So the consumer is thrilled because their breakfast is cheaper, but the top-line revenue number on the spreadsheet looks incredibly sluggish.
Precisely. The 1% growth isn't necessarily because foot traffic is down or people are buying fewer items. It's partially because the items they're putting in the cart, specifically these highly volatile commodities, just cost less.
I see.
The revenue shrinks, but the profit margin on that dozen eggs might actually remain exactly the same.
That makes perfect sense. The total cash register ring is smaller, but they still kept their 50 cents of profit on the carton. So that explains why the 1% sales number isn't as weak as it looks.
Right.
But that still doesn't explain the 6% jump in earnings. If the profit margin per item is staying roughly the same, where is the extra money coming from?
That brings us to the second, much more consequential lever management pulled this quarter. Ferocious cost reduction.
How ferocious?
Management reported that their cost of goods sold, the XGS savings, were 30% ahead of their internal plans for the first quarter.
30% ahead of plan in Q1 alone? That isn't just trimming the fat, that is a structural overhaul.
It really is.
But my concern here is how they're achieving that.
Yeah.
Because usually when a legacy company brags about cost savings beating expectations, it is corporate code for mass layoffs or slashing customer service.
That's the typical playbook, sure. But that is not what is happening here, which is why the analysts were so impressed. They are finding efficiencies much deeper in the machine.
Like where?
Greg Foran talked extensively about pressing harder on supplier negotiations, leaning further into direct sourcing, and entirely removing waste from what they call goods not for resale.
Okay, let's unpack the mechanisms there because I find this fascinating. Let's start with supplier negotiations.
Sure.
When food manufacturers are dealing with their own high costs for labor and transport, how does a grocery store force them to lower their wholesale prices? Because Kroger can't just demand that Pepsi or Kraft take a loss.
No, but Kroger has ultimate leverage, shelf space and data. If a national brand wants premium placement at eye level in 2,000 stores, Kroger can demand better pricing tiers.
Ah, pay to play.
Exactly.
Yeah.
Furthermore, because Kroger has such a massive private label business, they can go to a national supplier and say, look, if you don't bring your wholesale costs down, we are going to allocate 20% more shelf space to our own store brand alternative, which is currently cheaper than your product.
Wow.
The supplier is forced to find efficiencies on their end to remain competitive on the shelf.
So they are weaponizing their own store brands to keep the national brands in check. That is incredibly aggressive.
Very aggressive and very effective.
And what about goods not for resale? That sounds like an oxymoron for a retail store. What exactly are they saving money on if they aren't selling it?
Goods not for resale is the invisible backbone of a grocery store. We are talking about the wooden pallets, the industrial shrink wrap, the receipt paper, the shopping carts, the cleaning supplies, the employee uniforms.
It's just the operational overhead.
Yes. By centralizing the procurement of these items, applying AI to optimize their supply chain logistics so trucks aren't driving around half empty, and reducing organizational layers in corporate management, they're stripping millions of dollars of waste out of the system without impacting the customer's experience one bit.
Okay, so they are squeezing more profit out of the logistics and the back room rather than the consumer's wallet.
Exactly.
But here is the critical question. What are they doing with that cash? Because they could just drop all those savings straight to the bottom line, inflate their profit margins, and pay out a massive dividend to shareholders.
They could. But the CEO described these cost savings as building up deposits in a strategic bank account, and they are aggressively withdrawing from that account to intentionally invest in two things.
Which are?
Surgical price cuts for the consumer to drive foot traffic and associates. In fact, they specifically noted that their operating, general, and administrative rate, their OG&A, actually increased by 16 basis points.
Wait, their administrative and operating expenses went up? In an environment where everyone is trying to cut costs, why would they intentionally let their operating expenses increase?
Because they are choosing to invest the money saved on supply chain logistics directly into the physical source.
No, I see.
They increased store hours, funded better training for employees, and rolled out new uniforms. They're making a calculated bet that a clean, well-staffed, well-trained store is the absolute best way to win market share from competitors who are slashing labor.
So they aren't hoarding the cash for a short-term profit spike. They are reinvesting it to widen the moat between them and the rest of the industry.
Precisely.
That is a brilliant defensive maneuver. But, there is a ceiling to how money you can save on electricity, shrink wrap, and supplier negotiations, right? At a certain point, you run out of fat to trim.
You do.
To actually achieve aggressive high-margin growth, they had to look entirely outside the physical grocery aisles. Which brings us to the most explosive part of this earnings call, the digital cart.
This was undeniably the most fundamentally bullish takeaway from the entire transcript. It is a milestone moment for the company and, frankly, for the entire grocery sector.
What happened?
Kroger announced that their e-commerce business, which crucially includes their retail media network, has officially turned profitable this quarter.
Wow. I really want the listener to grasp how massive that is, because for years, the conventional wisdom on Wall Street was that delivering groceries was just a bottomless money pit.
A total sinkhole for cash.
Yeah, the unit economics were horrific. You had to pay an employee an hourly wage to walk the aisles, pick the exact items, carefully bag them so the bread doesn't get squashed by a jar of pickles.
Maintain a cold chain so the ice cream doesn't melt in the summer.
Exactly. And then pay someone to drive a vehicle to a house. It was viewed purely as a defensive service you offered just to avoid losing your customers to Amazon. It wasn't supposed to actually make money.
Right. And now Kroger has crossed the Rubicon. They are in the black.
And they aren't just eking out a tiny profit while the division stagnates either, are they?
Not at all. E-commerce grew by a staggering 19% this quarter.
19%. While the physical stores limped along at 1%. That divergence is wild. What is the mechanism driving that kind of digital growth?
It comes down to one word: convenience. And specifically, sub-1 hour deliveries.
Okay.
The CFO noted that convenience orders delivered in under an hour represented approximately 50% of their total digital growth.
Let's talk about how they're pulling that off, because the logistical pivot they made here is fascinating. For the last 5 years, the massive trend in grocery e-commerce was trying to build these billion-dollar, fully automated mega warehouses.
The Ocado sheds, yes. Kroger heavily invested in that partnership. They built massive automated customer fulfillment centers.
Right. These giant centralized hubs out in the suburbs filled with robotic grids picking apples out of bins. But listen to what management actually admitted to doing this quarter.
It's a huge pivot.
They closed 3 of those unprofitable fulfillment centers. They shut down the robot mega warehouses in certain geographies. And instead, they leaned heavily into third-party delivery partnerships with Uber Eats and DoorDash.
Yes.
They basically stopped trying to build a centralized, capital-intensive logistics empire from scratch and realized that their 2,000 existing physical stores were already the ultimate hyper-local distribution network.
It's a brilliant realization of embedded infrastructure. Think about the physics of delivery for a second.
Okay.
If you have a massive, highly efficient, automated fulfillment center 50 miles outside the city, you cannot offer sub-1 hour delivery. It is literally bound by the laws of traffic and geography.
Right, it's just too far away.
But if you fulfill the order directly from the neighborhood grocery store that is already sitting 3 miles from the customer's house, and you utilize a DoorDash driver who is already circling the block looking for a fare.
Suddenly, sub-1 hour delivery isn't just possible, it's highly scalable.
And incredibly capital light. You don't have to buy the delivery van or hire the driver full time.
And the craziest part is they noted they successfully converted nearly all the households from those closed fulfillment centers over to the new store-based delivery model.
They didn't lose the customer base when they shut down the warehouses.
Right, they just found a cheaper, faster way to serve them. That is operational wizardry.
It really is. But as much as the delivery economics are improving, we have to look deeper. The real secret weapon, the actual engine that pushed the e-commerce division into profitability, is KPM, Kroger Precision Marketing.
This is exactly what I meant in the intro when I said they are behaving like a digital advertising platform. Kroger Precision Marketing, their in-house retail media arm, grew over 20% this quarter.
Yes, it's exploding.
Let's explain why retail media is the absolute holy grail for a grocer. Because to the average person checking out on their phone, KPM just looks like a standard banner ad for Doritos on the app.
Sure. But to understand the sheer power of KPM, you have to understand the depth of the data lake they are sitting on. The CEO dropped a statistic on this call that should make any advertising executive's jaw drop.
What was it?
95% of all transactions at Kroger are tied to a loyalty card.
95% of billions of transactions.
Yes, and they have over 20 years of continuous history on those cards. Think about the fundamental difference between advertising on Google versus advertising on Kroger.
Okay, walk me through that.
If you search for healthy snacks on Google, the algorithm knows your intent. They know you are currently thinking about healthy snacks, and they will sell an ad against that search intent.
Right, but I might just be researching a diet, not actually buying anything.
Exactly. But if you scan your Kroger Plus card, Kroger doesn't care about your intent. They know your actual verified purchase behavior.
Because I actually swiped my card at the register. They know exactly which brand of granola bars I bought, how much I paid for them, what day of the week I bought them, whether I used a coupon, and whether I also bought Greek yogurt to go with it.
Exactly. It is closed-loop, deterministic data. And that is infinitely more valuable to brands and advertisers than a guess based on a search history.
So a massive consumer packaged goods company like Kraft or Pepsi will pay an enormous premium to advertise directly on Kroger's app or website.
Because Kroger can offer SKU-level conversion reporting.
Oh, yeah.
They can go to the brand and say, look, we showed this specific customer your banner ad on Tuesday afternoon, and on Thursday at 5 p.m., they physically walked into a store and put your product in their cart.
It's the ultimate proof of return on investment for the advertiser.
It is.
And Kroger isn't just keeping this data siloed on their own app anymore. The transcript highlighted that they just secured highly targeted ad partnerships with Google's Display and Video 360 platform.
This is huge.
They are essentially letting advertisers use Kroger's proprietary retail signals to reach audiences while those people are watching YouTube. And they became the first retail media network to launch a self-service collaboration with TikTok.
That is the defining pivot in their business model. They are taking their proprietary first-party data and using it to monetize audiences across the most influential media platforms in the world.
They are acting as a data broker and a media agency.
Yes. And remember, the profit margin on a physical gallon of milk might be 2%, right?
If you're lucky.
Exactly. But The profit margin on selling a digital advertisement is practically 100%. The infrastructure is already built, so every new ad sold is pure profit.
Plus, the data proves that a digital customer is simply a more lucrative customer overall. Management noted that their omni-channel shoppers, the people who buy both in-store and online, spend nearly 2.5 times more than a customer who only shops in the physical store.
2.5 times the spend. So when you combine a customer who is spending significantly more money, the lower variable cost of fulfilling orders from local stores rather than massive warehouses, and the 100% margin revenue of selling ads through retail media, it is no wonder the e-commerce division finally crossed the threshold into profitability.
It really is the perfect storm for digital margins.
And the CFO explicitly stated they expect this profitability to accelerate rapidly through the remainder of the year and beyond.
It is an incredibly bullish narrative for the tech side of the business. The digital part and the ad network are firing on all cylinders. But as investors, we can't get so blinded by the shiny tech margins that we ignore the physical box where the actual food is sold.
Right, you still have to run the grocery store.
Exactly. Because while KPM is printing money in the cloud, the physical aisles are dealing with a much messier reality.
Which brings us to the macroeconomic environment. The consumer reality inside the physical store is highly pressured, and management did not try to sugarcoat it on the call.
No, Greg Foran was remarkably blunt. He stated outright that the customer is under immense pressure. They cited high gas prices and reduced S&AP benefits, what most people refer to as food stamps, as major headwinds squeezing household budgets.
It's a very real problem.
They specifically mentioned that the reduction in S&IP benefits is hitting 3 states particularly hard.
The S&AP cliff has been a massive issue for retailers across the board. During the pandemic, benefits were expanded, and when those emergency allotments ended, billions of dollars in grocery purchasing power just evaporated overnight from the lowest income households.
And when budgets are squeezed that tightly, you immediately see a shift in consumer behavior. The transcript noted that food at home growth actually decelerated by 100 basis points compared to the previous quarter.
Customers are shopping selectively, they are making lists, managing their spend with real intent, and skipping the impulse buys.
But here is the mechanism that protects Kroger from that downturn. Often you'll hear analysts talk about discount retailers catching a falling knife when consumers run out of money. But that's the wrong metaphor here.
How so?
Because catching a falling knife means you get cut. Kroger's strategy is more like having an airbag deployed. When the consumer trades down to save money, they don't necessarily leave the store. They just trade down into Kroger's own private label brands.
That's a perfect analogy. The transcripts show that our brands, which includes their massive private label lines like Simple Truth and Private Selection, outpaced national brands by 175 basis points this quarter.
And from a profitability standpoint, that is a massive win, because private label brands generally carry a substantially higher profit margin for the retailer than selling a national brand like Kellogg's or Nabisco.
That's a huge difference in margin.
Right. If I decide I can't afford the $5 name brand sparkling water and I switch to the $3 Private Selection sparkling mineral water, Kroger actually makes more net profit on the cheaper item because they don't have to pay a middleman or fund a national marketing campaign.
Exactly. The wholesale cost is radically lower. And the CEO talked about changing the entire company mindset to think like item-level merchants.
What does that mean in practice?
He mentioned specific successes they've had innovating with their private labels, like a new garlic and herb rotisserie chicken, a black diamond watermelon, and Guatemalan Antigua coffee. He said, and I quote, "Customers don't buy assortment, they buy items."
Meaning you can't just have 50 types of generic pasta in a white box and expect people to be excited.
Exactly. Every single private label item has to be so good it earns its place on the shelf and genuinely delights the customer, not just serves as a cheap fallback.
It's a relentless focus on execution and quality control at the lowest possible price point.
It is.
But while the grocery aisles are successfully deploying that private label airbag to protect margins, I want to talk about the back of the store. Because looking at the numbers for the pharmacy department, I am genuinely concerned.
It's a complicated sector for sure.
The CFO dropped some incredibly heady data regarding pharmacy headwinds. They stated that the Inflation Reduction Act caused a 130 basis point drag on total company sales.
Yep.
On top of that, a shift from brand name drugs to generic drugs caused another 40 basis point drag. We are talking about government regulations and generic drugs knocking almost 2 full percentage points off the entire company's top-line revenue.
Sounds bad.
As an investor, shouldn't I be deeply worried about the structural health of this pharmacy business?
I mean, if you only look at the top-line revenue on a spreadsheet, it looks alarming. But this is a classic Wall Street jargon translation moment. We need to break down the actual mechanics of that brand to generic shift, because the economics of a pharmacy are totally counterintuitive to a normal retail transaction.
Okay, walk me through the mechanism. Why is a drag on sales not a reason to panic?
Because in the pharmacy world, total sales revenue and bottom line profit are completely decoupled. When a customer shifts from a highly expensive patented brand name drug to a cheaper generic alternative, the total ring at the register, the top line sales revenue, goes down massively.
Right.
A $500 drug becomes a $50 drug. Hence, the 40 basis point drag on total company sales.
Right. The gross dollars flowing into the register are significantly lower.
But, and this is the crucial part that analysts care about, the profit margin for the pharmacy is actually higher on the generic drug than it is on the branded drug.
Wait, really? How does that work?
The branded drugs are tightly controlled by the pharmaceutical companies, leaving almost no markup for the pharmacy. The generic drugs have immense wholesale competition, allowing the pharmacy to buy them for pennies and capture a much wider spread.
Oh, I see.
So the top line looks worse, but the actual cash profit generated by the transaction goes up. The CFO explicitly stated that while the shift to generics is a headwind to sales, it is actively profit positive.
It's exactly like the private label groceries we just talked about. It's the pharmacy equivalent of buying the store brand sparkling water, lower retail price for the consumer, smaller top line revenue for the company, but a wider profit margin because you cut out the premium brand markup.
Exactly. You nailed it. And regarding the Inflation Reduction Act, or the IRA, the changes to Medicare Part D are playing out exactly as management forecasted.
Okay, so they were ready for it.
Yes. While it represents a 130 basis point headwind to total sales, the CFO noted that given the complex way pharmacy benefit managers and rebates work in the background, the IRA impact is entirely neutral from a net profit perspective.
That is fascinating. So the top line revenue numbers are taking an absolute beating, which looks terrible in a headline, but the actual cash going into the vault isn't negatively impacted at all.
In fact, the CFO noted that pharmacy profit actually grew ahead of their internal expectations.
Yeah.
And volume, the actual physical number of prescriptions being filled, is up.
So they are actively winning market share.
Yes. And this volume growth is being driven heavily by core scripts, and specifically the massive boom in GLP-1 weight loss drugs like Ozempic and Wegovy.
Which brings up an incredibly interesting dynamic, because those GLP-1 drugs have a fascinating halo effect on the rest of the store.
They really do.
Management pointed out that a consumer who comes in once a month to fill a GLP-1 prescription doesn't just grab their medication and leave. They have to walk through the grocery aisles. And more importantly, the medication is fundamentally changing their eating habits.
Right. They are experiencing suppressed appetites, so they are buying fewer, highly processed, high-margin junk foods, which is a risk.
Right. You'd think that hurts the grocery side.
But they are actively looking for more fresh food, salads, and higher protein items to maintain muscle mass. Kroger's vast ecosystem of fresh produce and private label proteins is perfectly positioned to capture that shifting basket.
So if we pull all of this together to summarize the physical store reality, yes, the consumer is financially stressed, and yes, the pharmacy top line looks murky due to legislation and generic shifts.
Right.
But structurally, the profit engines in both departments, the private label grocery brands and the generic pharmacy scripts, are firing exactly as they need to, protecting the margins while the top line shrinks.
Which sets the stage perfectly for the most critical part of an earnings call: management guidance.
Exactly. Because between funding surgical price cuts to help those squeezed consumers, dealing with transport headwinds, and navigating these bizarre pharmacy quirks, what exactly is management promising Wall Street for the rest of the year?
Well, they held the line. Management reaffirmed their full-year guidance across the board.
Okay, so no panicking.
Right. They are projecting that Q2 identical sales will likely be flat compared to Q1, and Q2 EPS will be roughly in line with last year's performance.
So they are signaling a bit of a holding pattern in the immediate short term.
Short term, yes. The CFO noted that they expect inflationary pressures and supply chain costs to actually increase slightly as the year progresses. However, they are highly confident that profit growth will accelerate significantly in the second half of the year H2.
Wait, why the sudden jump in the second half? If inflation is ticking up, what's the catalyst for profit growth?
It all comes back to those deep structural cost savings we talked about at the beginning.
The 30% ahead of plan stuff.
Yes. The operational initiatives they are putting in place right now, the AI supply chain efficiencies, the brutal supplier negotiations, the reduction in overhead, those savings have a compounding effect.
So they build on themselves over time.
Exactly. They are going to ramp up heavily in the back half of the year. The CFO flat out said that the cost savings will outpace the investments they are making in price cuts and store hours, which is what gives them the mathematical fuel to hit their profit targets, even if top-line sales remain sluggish.
And when we look at their ability to execute that plan, we cannot ignore the strength of the balance sheet. They reported that their debt to adjusted EBITDA is sitting at a remarkably healthy 1.75.
Yes, that's a critical number.
Let's explain EBITDA really quickly. It stands for earnings before interest, taxes, depreciation, and amortization. It is basically the purest proxy for the raw cash flow the core business generates before accounting tricks.
Right.
So a debt to EBITDA ratio of 1.75 means it would take them 1.75 years of their current cash flow to completely pay off all the corporate debt. Is that good or bad for a grocer?
It is exceptional. To put that in perspective, their own internal target ratio for a healthy balance sheet is between 2.3 and 2.5.
Oh, wow. So they're well under their own target.
Exactly. They're operating well below their target debt levels, while simultaneously generating massive free cash flow.
So what does operating with that little debt actually allow them to do?
It gives them massive strategic optionality. Because they maintain a pristine investment-grade credit rating, they have the dry powder, the financial capacity to invest in long-term, high-return opportunities without stressing the financial foundation of the company.
Like what kind of investments?
If they want to aggressively expand their digital ad network or acquire a massive new data analytics firm, or even just aggressively buy back their own stock to boost the share price, they have the cash and the borrowing power to do it instantly.
Okay, so we've got all the data on the table. We've looked at the egg deflation masking the sales numbers, the aggressive supply chain efficiency, the milestone of digital profitability, the absolute boom in retail media data, the airbag of private label strength, the counterintuitive pharmacy margins, and a rock-solid balance sheet with plenty of dry powder.
It's a lot to process, but yes, that's the whole picture.
Now, I have to ask you the ultimate talk tickers question. For the retail investor listening right now, who has their 401k pulled up and wants to know if this stock is a buy, a hold, or a sell, what is your verdict? Is this quarter a bullish or bearish signal for T$?
I am taking a strong, highly opinionated stance here based on this transcript. This is a definitive bullish signal.
Walk me through the thesis.
Because Kroger's strategy of threading the needle is working flawlessly in an incredibly difficult macroeconomic environment. Look at the retail landscape right now.
It's pretty fractured.
Very. You have hard discounters like Aldi and Walmart aggressively eating up the bottom end of the market, winning the most price-sensitive consumers. And you have premium grocers like Whole Foods fighting for the top-end, high-income shopper.
Right.
Kroger sits squarely in the middle. And historically, the middle is a highly dangerous place to be when the consumer is financially squeezed.
Yeah, the middle usually gets completely hollowed out. You aren't cheap enough for the budget shopper, and you aren't fancy enough for the premium shopper.
Exactly. But Kroger isn't getting hollowed out. They are actively pulling away from the middle of the pack. They just posted their best performance against traditional grocery competitors in over 3 years.
Wow. Okay. How?
And they are doing it through sheer operational and financial discipline. They are taking massive internal cost savings from their supply chain and using them to fund highly surgical price investments on key items.
They aren't trying to be the absolute lowest priced retailer on every single item in the store.
No, they are making their prices competitive enough and consistent enough that customers choose the convenience, the fresh produce, and the localized experience of Kroger over driving across town to a hard discounter to save a few pennies.
They are literally subsidizing the consumer's grocery bill with back office operational efficiency.
Yes. And even more importantly, they are subsidizing the entire low-margin physical operation with the high-margin digital business.
That's the real magic trick.
When you have a rapidly growing retail media network partnering with Google and TikTok, generating massive profits from data, and an e-commerce delivery arm that is finally operating in the black, using localized store fulfillment, you have an incredibly resilient, multi-layered business model.
So they're insulated from the typical grocery shocks.
Combine that structural advantage with a pristine balance sheet that offers massive flexibility, and you have a stock that is perfectly positioned to weather current consumer inflation, protect its margins, and aggressively take market share in the back half of the year.
I love that analysis. The underlying foundation is so strong that they don't have to panic. They can afford to play the long game on price and customer loyalty, while their competitors are forced to slash services just to survive.
And as a final bullish point, let's look at the new CEO's 100-day assessment. Greg Foran was radically transparent on this call.
Yeah, I was surprised by that.
He didn't just highlight the wins. He stated straight out that a full fifth of their physical stores are lagging behind company standards and need drastic improvement.
That's 20% of their footprint.
Exactly. He openly admitted they haven't been opening enough new stores to capture geographic growth. That level of honesty is refreshing from a CEO, but more importantly for an investor, it outlines a incredibly clear, highly achievable roadmap for internal growth.
It's essentially embedded upside. They don't have to invent a brand new market or rely on some speculative new product, right? They literally just have to execute basic retail fundamentals better in the buildings they already own.
Yes. If they bring that bottom 20% of stores up to the baseline standard, the revenue lift across the entire company will be immense.
That makes total sense.
The execution roadmap is clear, the work is already underway, the digital ad engine is highly profitable, and the balance sheet is bulletproof. The thesis is deeply bullish.
So what does this all mean for you, the retail investor? Let's wrap this up and distill everything we've talked about. The core takeaway from this deep dive is that Kroger is effectively engineering a massive internal transfer of wealth within their own business model.
That's a great way to put it.
They are utilizing high-margin digital advertising, 2 decades of incredible loyalty card data analytics, and aggressive AI-driven operational cost cuts to quietly subsidize the core low-margin grocery business.
Which allows them to keep shelf prices highly competitive for a stressed American consumer.
And quietly win market share from traditional competitors who don't have a digital ad network to lean on.
They are entirely transforming the economics of the supermarket from the inside out.
Which leaves us with a fascinating, almost mind-bending question to ponder as we close out this deep dive. With Kroger officially turning a profit on e-commerce, abandoning the dream of automated mega warehouses in favor of hyperlocal store logistics, and integrating 2 decades of granular SKU-level loyalty data directly with TikTok and Google advertising algorithms.
It truly is a completely different paradigm than it was 5 years ago.
Are we fast approaching a future where Wall Street and retail investors need to completely stop valuing Kroger as a traditional low-margin grocery stock? And instead, do we need to start valuing it as a highly localized, high-margin, data-driven tech and media company that just happens to sell you your bananas on the side?
That is the multi-billion-dollar valuation question. Because tech companies trade at massive multiples compared to grocers. And based on this quarter's results and the growth of KPM, the argument for a tech valuation is getting stronger every single day.
It really is. Thank you for joining us on this Talk Tickers deep dive. We've ripped through the jargon, looked hard at the mechanisms behind the numbers, and hopefully given you a much clearer picture of the digital machine operating quietly behind the grocery aisles. Keep a close eye on those cost savings and pharmacy volumes in the back half of the year, and we will see you on the next deep dive.